The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair MacLeod on behalf of Gold Money. And with me on the line, I think from Germany, is Gonzalo Lira, who writes the Gonzalo Lira blogspot.com. I'll put my teeth in a moment. He's a very, very popular blogger and writer and filmmaker. Gonzalo has Chilean origins, which is interesting to me because he has first-hand knowledge of the Chilean inflation, and given that there is a huge debate about monetary inflation worldwide at the moment, anything he can tell us about that will be very interesting. He writes for Zero Hedge, Naked Capitalist, Seeking Alpha, and Business Insider. Welcome to the podcast, Gonzalo. It's very nice to have you on.
It's a pleasure being on. Thank you for having me.
You're in Germany. You're in Germany at the moment. Am I right? So
yeah, that's right. I'm actually right here in Flensburg, just having seen the whole Apple thing where they released the phone.
Oh, right. Well, what's interesting is that yesterday was the day in which the Constitutional Court came out with their ruling. Have you had any feedback from locals on that? Do you get any sort of sense of how that's being taken?
They're not taking it very well, but this is strictly anecdotal. This isn't any kind of polling. It's just the people I know and the circle I know here. They aren't too keen on it because, in general, the Germans do not. Frankly, they don't like the south of Europe. The south of Europe being the PIIGS, of course: Greece, Italy, Spain, Portugal, and Ireland to a lesser extent. They are the people that I know here are very sophisticated and they understand what is going on. But Germans have an inability to accept the fact that part of the reason that these southern countries are in the hole that they're in is because of Germany. Because Germany essentially gave them vendor financing, cheap money, so that these countries could go out and spend by buying German goods in many cases. And so it's you always have to remember, it seems to me, that whenever anybody's over-indebted, there are two people at fault: the person who's over-indebted and the fool who lent him the money. And so the Germans aren't very keen on this, but they only see the part of they should have been responsible, the PIIGS should have known what they were doing, it's their fault, we shouldn't bail them out, it's their problem, they should sink. Which is, of course, an untenable proposition, as Angela Merkel well knows. And so there is popular discontent. And insofar as this decision is concerned, there was not that much surprise, but at the same time, there was a sense that among Germans that this isn't fair. But, you know, that's physically anecdotal. This is my perception here.
Yeah, no, That's interesting. I mean, the thing that's going through my mind is that the opinion polls in Germany broadly support what you're saying. I think that there is discontent over the thing. But the sense I get of what you're saying, Gonzalo, is that perhaps amongst the, if you like, the more I hesitate to use the word intelligent, but the if you like, the sort of the middle classes, maybe the upper middle classes, who I guess are the people that you're mixing with, have probably got a greater sense of the stupidity of the situation than the public as a whole. Is that a fair comment, or am I off target?
Yeah, of course. You're absolutely right. I mean, the more sophisticated realize what happened, that essentially with the monetary union, you created the conditions whereby the favorable lending rates that were given to Germany were extended to all the countries of the eurozone, with the implicit promise or the tacit agreement that if anybody got into trouble vis-a-vis their debt, the entire European Union would come and save them. And so the more sophisticated Germans, of course, realized that the system was flawed from the get-go because they created a monetary union without a fiscal union. And now they're trying to create some sort of fiscal union by the back door, as it were. But I don't think that this fiscal union is going to happen. I mean, personally, I think that at the end of the day, Greece is definitely going to have to exit the eurozone, and I think that Spain is too.
Well, I mean, it's interesting because I remember back to the days when the euro first started. Before Greece joined, I think I'm right in saying that government bonds yielded something like 12 or 14%. And then when the intention of joining was sort of, firmly on the block, the yield started falling. And I think they got down to something like 3%. Because what the banks were doing was they were round tripping. They're effectively gearing up 20, 30 times to take a 1% differential between, say, German bonds and, or, if you like, borrowing rates and the yield on Greek government debt. So, it seems to me that what you're saying about, there are two parties to this. You've got the lenders and the borrowers, is absolutely right. And the German banks, of course, were in the forefront of doing this, along with everybody else.
Yeah, something I've noticed in Germany, I had never spent an extended period of time in Germany. I'd been here on business and traveling, that sort of thing, but never, months or weeks here in the country. I've been here now 3 months. And one of the really interesting things is that Germans are incredibly law-abiding, the lower on the social echelon, as it were. I'll tell you a true story. I was here in Flensburg, and at this pedestrian crossway, there was this elderly couple, and they were waiting for the green light on the pedestrian crossway. Okay, but they were very, Germanically waiting for the green light. Okay, on a pedestrian crossway. I mean, there's no danger. It was strictly for pedestrians, and they waited. It seems to me that the Germans are very much rule bound on the lower echelons, but as you sort of creep up, especially among the higher echelons socially in Germany, you start to see a weird kind of a certain breed of corruption within the rules, if you were, where people do things that are technically legal, technically within the law or the rules, but which are not beneficial in the long run. And they know that it's not beneficial in the long run, and they know that in a sense it's sort of immoral. This is a highly, highly subjective opinion, but it's very interesting because there isn't the kind of corruption or graft that you see at the lower levels in other countries. In Germany, that just doesn't seem to exist. But it's the higher echelons where they bend the rules and they're not quite straight. And the banks, of course, in Germany did a lot of stupid things. The Landesbank did the whole host of very, very stupid loans. And so, of course, the Germans have been saying, oh, yes, Greece should exit and just, take it like a man, as it were. And then they start sitting down and actually cranking the numbers and realizing what kind of exposure the German banks would have. And they realize, holy smoke, they're going to take a big hit if Greece exits. And they're throwing more money after bad, as it were. And they realize that they're throwing more money after bad. But they don't seem to me to have any kind of idea as to how to get out of this hole except to do what they're doing, which is throwing more money after bad.
But wasn't it ever thus? You get, you lend money to someone, and they then come back to you a month later and say, look, I'm in real difficulties now. This has happened. Hard luck story. Can I have another $5,000? I mean, that's the position they're in, isn't it?
Yeah, basically. Yeah.
Yeah.
Okay. And so I think that they're doing it because, of course, the ECB came up with the announcement where basically it says we're going to buy all the bonds that there are out there. We're going to prop up the sovereign bond market. And you saw I follow the Spanish yields, which for me are crucial. And the Spanish yields dropped half a percentage point overnight. And it's right now it's at 5.7. A couple of weeks ago it was at 7.5 and rising. I'm talking about the 10 years, right? Yeah. Of Spanish sovereign debt. And the Spanish sovereign debt was looking like it was just going to go Greek, and all of a sudden one announcement, boom, everything's fixed. Now, the issue becomes, is Mario Draghi, he's saying that he's going to put all these conditions and he's going to be really strict and he's not going to be Mr. Nice Guy, but he's going to buy all the bonds necessary so long as the countries follow these rules or these conditions that he puts, right? Yeah. Now, the issue becomes, how hard is he going to be insofar as holding these countries to these conditions? Because already you see the Spanish government is saying, oh, going to buy all my bonds. Oh, but you want conditions. Oh, well, now we have to think about it.
Yes, and not only that, but the fall in yields basically has meant that Rajoy has turned around and said, well, I don't think we need a bailout after all.
Exactly. Okay. So, is it going to be like this yo-yoing back and forth where yields start to creep back up? Draghi says, I'll save you. Yields fall, and they say, oh, no, thanks. We don't need you to save us until the next go around. I mean, how is this situation going to end? I think that what's going to happen is that somebody's going to have to play. It seems that they're playing a game of chicken with sovereign yields. Now, the issue I think is going to be that somebody's going to eventually flinch. I'm mixing my metaphors terribly, but I think you understand my point. And I don't think it's going to end nicely.
No, I think time is the enemy of the indebted, I think is the short answer. As time goes on, their position gets worse. The only justification for lending more money to Spain is that this would engender an economic recovery. And then they get the tax revenue to start paying interest and paying it back and all the rest of it. But there's no way that situation is true in this case, is it?
No, it doesn't seem so to me. I mean, the worst part of all this, if Greece had defaulted 2 years ago, right?
Yeah.
It would have cost like about 120 billion euros, right? And we'd be done with the problem.
Yes.
Okay. It would be over. It would be a non-issue. Greece defaulted. The eurozone took the hit back in 2010. It was unpleasant, blah blah, but it cost 120 billion, blah blah, and a lot of juggling had to go on with some of the German and French banks, but they were still able to sort of like maintain. But the problem is that in these 2 years that the problem has been kicked down the road, all of the creditors have gotten weaker, okay?
Yeah.
And all of the debtors' holes have become bigger.
Yes.
Okay, so it's a bigger problem. I remember when I was a little kid, I did some mischievous thing. I forget what it was. It doesn't really matter. And what happened, of course, is I didn't tell my mother. And I waited and waited and waited, and every day it was worse,
Yes.
And eventually the punishment was much worse because, if I just come clean, and I think that that's a lesson that all of us learn at some point in our when we were younger, that it's just better to take the hit. Just stand still and take the beating. Okay.
Yeah.
Like the Icelanders did. What did the Icelanders do in 2008? They took the hit and now they're sitting pretty.
There are a lot, certainly. That's very, very true. And lots of people, of course, have observed this. But surely part of the problem is that we're very used to talking about central government debt in this context. Like Spain's central government is, 70% of GDP, and they've got a deficit of that, so it's rising at such and such a rate and so on. But that's only part of the story because we now see that the local authorities, the regions are going bust. The regions are turning around saying, can we have 5 billion euros and can we have another 1.2 billion so on? And they're all doing it and they're not paying their bills. So you've got all this debt in the background is mounting up. And then on top of that, you've got nationalized industries, which are not consolidated into the central accounts. You've got off-balance sheet debt accumulating in the form of welfare payments and all the rest of it and pensions. I mean, really, I think what we're looking at is only a small part of the problem. The problem is far bigger than stated. Would you agree with that?
Absolutely. Just to take Spain, just to look at the Spanish problem. Okay, for a long time, people dismissed Spain when I would bring it up as a worry because they'd say, "Oh, the government only has 60% GDP indebtedness, right?"
Yeah.
But I would say, "Yeah, that's the central government, but the regional governments, you add those up, and it was 120, 130%, 2 years ago, and now it's gotten worse."
Yes.
Now you have that problem. Then you have the problem of something that the Germans were wise enough to do during the aughts, which is labor reform. Because the problem in Spain is that it is so expensive to hire or much more fire somebody in Spain. People just don't hire anybody, okay?
Yep.
And so you have this labor inflexibility because of a lack of labor reform that should have been done in the good days, as it were, in the days of milk and honey with a lot of cash, which is what the Germans did.
Yep.
Now, that labor reform is very, very painful, and the Germans didn't like it at all. But of course, in the long run, It improves efficiencies. It allows for a much more flexible labor market and allows for a turnaround in an economy. Now, when you have the kind of labor restrictions that exist in Spain today, or Italy today, or Greece for that matter, it is so expensive for...
Or indeed France.
Yeah.
I mean, France is notorious.
It's so expensive to hire somebody new that you don't hire somebody new until you're absolutely positively sure that you're growing. Now, of course, this is fine for one business, but when the entire economy is working under that mentality, then there's no growth because everybody's sort of like waiting for the other guy to stand up in a dinner party, and nobody does because everybody's just looking around and waiting for the other guy to get up, right?
Yep.
And so that's the problem that we have insofar as Spain is concerned. We have a massive indebtedness of both sovereign and the regions. You have the banking sector of Spain, which is a complete disaster. You have labor inflexibility, and you have a population that has become accustomed to a standard of living which was simply unsustainable, and they are demanding that they continue, and they are protesting when they have to take a hit. So you have all these problems that are making it that much more difficult to actually implement a long-term solution. The long-term solution is to default, let the chips fall where they may, and start over. That's my opinion. Perhaps that's an Olympian attitude or a very cavalier attitude, because I recognize that kind of letting the chips fall where they may approach would cause tremendous damage. But I think that kind of damage would be restricted to a fairly short amount of time. I mean, a year, 2 years. Do we really want to have Europe go 2 decades like the Japanese, limping along and not really getting anywhere as an economy? Is that what?
Well, yes, I think the point is well made. It seems to me that kicking the can down the road, the sort of the cliche. We're running out of time to do that, and that's one side of the problem. The other side of the problem is that the politics of it are that it is impossible to face up to this reality, so they continue to fiddle along. So. Would you think that the only likely outcome of this is a collapse of the currency eventually, unless something is done?
I've thought about that a lot, and that's an extremely, extremely good question. In my subscription service, liraspg.com, we have a whole unit about what to do if Europe breaks up, if the eurozone breaks up, if 2 or more countries exit, and what would happen in that eventuality. And we went into it in great detail, and it was like a very large study as to that particular issue. And here's the thing that I'm starting to realize. There's modern monetary theory, which is a school of Keynesian economics that believes that basically money is just tokens, and it doesn't really matter. A government can never go broke because it can always print its way out of its hole. Okay, and I object to it for various reasons, and I'm giving a hugely simplified version of the argument. But for purposes of our conversation, that's not the point I'm trying to make. The point I'm trying to make is they might actually be right insofar as Europe, because they might be able to pull a Japan, as it were, with the euro, which is just keep trying to prop up the economy with via the ECB, with Frankfurt just doing whatever it takes to just keep the economy sort of going and covering holes in a haphazard kind of way indefinitely. Okay, yeah. Because I was of the opinion that we're going to reach some sort of collapse. But the more I look at it, the more I'm realizing that clowns might be able to kick the can down the road indefinitely, or for so long that it is for practical purposes indefinitely. I mean, 20 years in Japan, which is what the Japanese did. They for quite a while. I mean, 20 years is a long time to be kicking the can down the road, and they're still kicking it down the road, because really the collapse happened, in 89, 90?
Yeah.
So,
but surely there is a big difference between the Japanese economy, which was savings-driven, and the eurozone economy, which, with the honourable exception of Germany and perhaps the Netherlands and perhaps Austria, is consumption-driven. I mean, surely that's a huge difference, and I can't see that the Japanese case can be applied to Europe, if you see what I mean.
You're absolutely right. That there is that big difference, and it is a huge difference. That Europe is consumption driven, and don't be fooled. Even the the Germans consume quite a bit. I'm of two minds of this. I mean, I don't know how this is going to sound, so I just might as well just say it out loud. Part of me wants there to be a collapse, for this to be over, because all of us watching this, we're like on tenterhooks all day. We're like waiting for this to collapse, and it just doesn't collapse, and we're like, just die already,
Yes.
I mean, it's
I think
it's like one of these terrible soap operas where the main character, gets shot 20 times and he's still moving, and he's not dying, and he's still giving like these soliloquies.
Absolutely, it comes to the
die already.
It comes to the end of the program, and you get to be continued.
Yeah, exactly. Exactly.
I know what you mean. I think actually I would put it slightly differently and say that if we can get this out of the way, which really refers to what you were saying earlier, then we can move on, and actually people can rebuild their lives. Exactly. And so long as governments resist this, then that's not going to happen. Can we move? Sorry.
Go ahead. Sure.
I just wondered, can we move on a little bit? Because if we are looking at the potential of hyperinflation, not only in Europe, but perhaps in America, where perhaps this might be slightly more obvious because the situation is slightly more clear-cut insofar as you've got a fiscal position, you've got the government unable to fund itself except with the Fed printing money in order to do so, and so on and so forth. Yeah. We can see where in economic theory that is clearly going, unless there is something happens to change the direction. So looking at the overall sort of inflation thing, what fascinates me is all your connections from Chile. You've got lots of family connections at the highest levels going back. I remember reading one of your blogs a long time ago about the Chilean inflation, and I'm sure there are lots and lots of lessons from that. I'd be interested in your thoughts on that experience and how it might apply now.
Yeah, certainly. You have to understand, the period of Chilean hyperinflation happened between roughly June of 72 to September of 73. This was during the government of Salvador Allende, who was the socialist president of Chile from September of 70 to September of 73, and he was overthrown by the military coup led by Augusto Pinochet. And what happened in that case is not quite the situation we're in, because one has to understand that Salvador Allende was trying to implement a Maoist form of communism in Chile. Okay, yeah. It was a collectivized, a top-down kind of thing. It was very. He wasn't the secular saint that he's been painted out to be after the fact. And point of fact, at the time, he was just considered a nightmare because he was a nightmare. And the fact of the matter is, the issue that there was a coup d'etat is not the surprise. The surprise is that the military took so long. Yeah, exactly. Yeah. Because there were calls for a coup d'etat, I would say in early 72. And I'm not talking about the crazies. I'm talking about sensible people. The first president of Chile after Pinochet, Patricio Elwin, who said, I'm bringing democracy back to Chile. Well, he was one of the people, he was the head of the Christian Democrats in 72, and he was one of the people who went to the military to beg them to stage a coup d'etat, okay? Yeah. So, because what happened was that the Allende regime, what they did was, they did a lot of crazy things, but economically, the way they screwed the country was, they froze prices they froze prices across the board, and they obliged all wages to rise by, I think it was between 20 and 30%, okay, depending on the industry. And of course, what happened was that all of a sudden everybody had money, a lot more cash, and so what did they do? They went out and bought, and all the stores, all the shops were just instantly, goods were just vanished.
Yes.
Right? Yeah, exactly. Yeah. And created this rampant inflation and, of course, a black market. And then everybody started to dollarize. The economy became dollarized in the sense that people realized that they needed hard currency because the coin at that time, the escudo, was falling so quickly in value because of this policy. And the government was printing money in order to, pay its bills and what have you. And it was a collapse. It was just flat out incompetence. There's no other way to put it. But the lessons of that the lesson that I took from that is that, number one, inflation can happen very, very quickly. And the lesson is that in inflationary periods, there are tremendous opportunities. Now, insofar as the macroeconomic picture is concerned, the Chilean situation and the current situation in the United States and Europe, there's really no comparison to that. My concern, insofar as hyperinflation occurring in the United States, was based on the following very simple premise, which was, what happens if there is a run on treasury bonds, on U.S. treasury bonds? What happens if people come to the conclusion, the sensible conclusion, that the government will never be able to pay back its debt? Now, the U.S. federal government currently has $16 trillion worth of debt, which is equivalent of about 107% of U.S. GDP. Now, that debt is never going to get paid. I was of the thinking that there is going to be hyperinflation because all of a sudden, people are going to realize, hey, the government can't pay off these debts. But then we had QE and then QE2, and now we're going to have QE3, which was essentially the Federal Reserve printing up money and going out and buying these bonds indirectly, but buying them nevertheless. And, today, 60% of the 20 to 30-year Treasury bonds are on the balance sheet of the Federal Reserve. 60% of the 20 to 30-year U.S. Treasury bonds are on the balance sheet of the Federal Reserve. So what does that tell you? It tells you that the Fed is going to continue this bond purchasing situation, and for all intents and purposes, the government is never going to run out of money. But what incentive does that do to politicians? It gives them the incentive to continue to spend and continue what they're doing today. And so there isn't going to be any kind of cut in the military. There isn't going to be any kind of cut in the intelligence and state security apparatus that is growing in the United States. And in fact, soon we're going to have more and more programs for people, and it's just going to be a continuing printing because, Now, when will that turn into hyperinflation? I think that could happen in the short term. I was of the opinion, frankly, in 2010, that by 2012, we'd be in trouble because my thinking was there'll be a run on treasuries, just like a bank run, and what will people do? They will exit treasuries and go into the thing that they consider safest, which is commodities. Because, for instance, in Chile in 73, that's what people did. They got out of whatever assets they had and they got into assets that were most fungible, such as dollars, such as commodities. Now, that's what my thinking was insofar as a run on treasury bonds. But now that the Federal Reserve has been, frankly, so incredibly adroit at monetizing the U.S. federal government debt, because that's what they're doing, and they are very, very good at it. Because one of the things that we in the blogosphere tend to forget or ignore is that for all their stupid ideas, for all their misguided notions, the people at the Federal Reserve, they are very, very sharp customers, and they can pull off.
They're very skilled. They're very skilled, aren't they? Yeah.
And so you have to respect who you're dealing with. And these guys have been able to they have monetized the U.S. federal government debt to an unprecedented extent, and they've gotten away with it. And there is nobody in their right mind is thinking, treasuries they're about to collapse. What's the yield on the 10-year now? Like 1.53 or something like that?
Yeah. Do you think, Gonzalo, that to some extent they've had a little bit of luck insofar as?
Oh, sure.
I just sometimes wonder if the eurozone problems had not existed, how easy it would have been, or how difficult it would have been for the Fed to continue to kid everybody that you should buy treasuries yielding 0.25% over 2 years. It seems to me that they have benefited, if you like, from funk money rather than actually creating a case which people have bought into.
Yes, you're absolutely right. I mean, Mohammed El-Arian, the CEO, I forget which of the two he is, of PIMCO, the largest bondholder in the world, right? He said it best. He said, it's the least dirty shirt, he called it. He said, when you travel and you're stuck in a hotel, one extra night because you missed your flight or whatever, and you go through your clothes and you realize all of your clothes are dirty, what's the shirt you're going to wear? The least dirty shirt. The dollar is the least dirty shirt. And that's an excellent metaphor for the situation that we're currently in. Of course, everybody's, thinking that Europe is a basket case. China is looking worse and worse every day. Japan, we don't even have to worry about them because they're still in their zombie state. Where do we go? Where do we park our money? Well, the dollar, treasury bonds, but that's not a function of the virtue of the U.S. system.
No.
Now, it's incredibly dispiriting, to watch all this happen, because it seems to me just irresponsibility, and a failure of will to just face up to the problems. But oh well.
Yes. Well, this is really where I think that it's only a matter of time. I mean, whether it's tomorrow or the day after or in, 2 years' time or 3 years' time, I think before the sins that are being committed today in the monetary sphere actually begin to hit us very, very badly when it comes to the purchasing power of dollars, pounds, whatever it might be.
Well, my thinking, sorry to interrupt, but my thinking, you're absolutely right, but my thinking is still that it's not going to be a financial problem that triggers a run on the dollar and treasury bonds. Okay, my thinking, I used to think that it would just be natural progression, that financially it was just unsustainable, this level of debt, and that eventually people would wise up and say, hey, treasury bonds suck, let's get out of treasury bonds and go to commodities or what have you. Yeah. But now I'm starting to think there might be, rather than any kind of internal kind of come to Jesus moment by the financial community, rather on an extraneous event. Like, say, for example, a foolish Israeli hit on Iran, which closed the Strait of Hormuz, say. Or, say that, in Bahrain, the Shia majority actually manages to overthrow the regime and take over, right there again in front of the Strait of Hormuz, where, 60% of the world's oil passes by every day?
Yes, that's right. Yeah.
Yeah. And so my thinking has been, what if there is some world event, and trivial, that triggers this? People don't remember this, but the 87 crash?
Yep.
What was the trigger of that? It was some piddly little gunboat thing that happened in the Persian Gulf between – it wasn't even a big attack. It was just some gunboat little thingy going on. And all of a sudden, everybody panicked, and the market just collapsed the next day, Yep. And it was such an overwhelming collapse that people sort of like ignored what had actually triggered it. But I remember it very clearly, that it was this trivial little thing that happened in the Persian Gulf. The world's economies, like it or not, are still incredibly dependent on oil. And if there is any kind of disturbance there – it could really affect the world's finances badly. Okay, so
yes. Well, that's an interesting comparison, because we have equity markets rising and rising and rising on the back of zero interest rates, and with not a lot of buying in the background, and a lot of it seems to me to be driven by algorithms and all this sort of stuff, which actually is not human, which is a very important point. If you follow Austrian economics, then price is basically driven by humans. We now have them driven by computers in securities markets, and this could well expose the market to that sort of 1987 toppy risk from that sort of event.
Exactly.
Yeah, exactly. That's an interesting thought.
Yeah.
Coming back a little bit, I remember reading something you wrote about the Chilean experience.
Sure.
And one thing I remember was a story, and I've probably got it wrong, about a man who offered to buy a car, like a rubbish car, in return for an apartment in the middle of Santiago.
Yes.
Yes. The thing that struck me about that was that assets such as property in that situation are worthless except in the paper money of the day.
Exactly.
And I think this is very important for our listeners, because if any of our listeners feel that there is a risk that we move towards hyperinflation, they think of protecting themselves by owning property and things like that. I'd be interested in any thoughts you've got on that subject.
Sure. This is true. This happened to an uncle of mine, the husband of my mother's sister. Okay. So this is firsthand. Okay. He was a college kid in 72, 73. And he had this little POS Fiat 147. Okay. Which is just a a student car. He's studying architecture. Architecture. And so, this little car. He got offered an apartment in this very nice building, where actually one of the first, skyscraper apartment buildings in Santiago, which still exists. It's on a place called Rotonda Peresucuich. And point of fact, from my apartment where I live, I can see it. It's a lovely place. And it was like, I don't know, if I had to guess, something like 150 square meters, something like that. And the owner was saying, I'll give you the apartment for the car, okay? Because the car could be traded for dollars. But the apartment, nobody was going to pay him, whatever was the fair value of the apartment in dollars, okay? Because the economic situation in Chile was deteriorating because of hyperinflation. Yep. And so he was like, give me the car. And my uncle didn't do it, right? And of course, to this day, he regrets it. Yes. But it was an important lesson, obviously, because the car is long since gone and the apartment is still standing. It's a lovely, lovely place.
Yeah.
Now, of course, that emphasizes the following point, that when you have a currency collapse, what happens is that people are going to go into whatever is fungible, whatever is tradable, okay? Yes. Now, of course, real estate property is not tradable. It's not, it's not an easy thing, okay, when you have that kind of situation. So what happens is that when you have an inflationary situation, a hyperinflationary situation, what you have is properties start to fall in value. There was another piece I wrote, and I discussed this in detail at Lira SPG, where what I explain is how in hyperinflation, okay, what happens is that the price of debt goes up. And so it's impossible to acquire a loan in order to buy a particular property. And when it's impossible to get a loan to buy a particular property, that asset will simply go down in price until it reaches some buyer who has access to the cash or whatever fungible is going on to be able to purchase that particular property. Okay, I'm giving a highly
I think this makes an awful lot of sense, because really what you're saying is that the hyperinflation disrupts the loan market completely. And of course, where property depends almost entirely, like sort of 80 or 90 or even 100% on borrowing to finance that level of price, then you take that away, and obviously there's only one way for prices to go.
Exactly. You've said it. I couldn't have said it better. That's exactly right. And so the speculative bubble that we've experienced all around the world, I mean, it's not just happening in England or Europe or the United States, it's everywhere, is because of these cheap loans, this cheap debt, which is, that was brought to us by the central banksters, who have deliberately, with a view to pumping up the economy, kept interest rates low. My thinking is that interest rates should always be set by the lenders and the borrowers. Right? If I'm a bank and you want to borrow money from me, I go to you and say, well, are you willing to, take a 6% loan or 7% or whatever? And eventually you and I get to an agreement as to what kind of loan you're comfortable with and what I'm comfortable lending out. Yes. But if a central bank is dictating interest rates, that inevitably leads to the kind of warped perceptions in the market that we are experiencing today. All of the problems that we have had, that we are currently experiencing, are because in 1987, Alan Greenspan started screwing around with the interest rates and keeping them artificially low in order to pump up the economy. The famous Greenspan put. This is what we got because of the Greenspan put. And this hole that everybody's in, it's because of the Greenspan put.
Yes, so the problem actually goes back a long way. I think one last topic. When the Chilean inflation happened, there was the alternative of the dollar. You had what you termed the dollarization of the economy. Yeah. If we get a collapse of the dollar in a hyperinflationary collapse, then we don't have any paper currencies because all other currencies will go with it, I assume. So that just leaves us with gold and silver, I would have thought, maybe coming back as money. Would you think that's a valid point of view? And have you any comments on that?
We have to always remember that there isn't a hell of a lot of gold. I mean, in the world, it's not that there's not that much. Okay, no. So the idea of that the entire U.S. or European economy can go back to gold, and people walking around with little silver coins and buying stuff with that. I think that it's in a practical sense, it's difficult, if not impossible. Okay, a lot of people are very much against fiat currency. And I respect that opinion. I personally am not against fiat currency so long as it's managed responsibly, okay? Because the problem with having a currency that is actually based on gold is that there's simply not enough of it to go around.
But
okay?
isn't that But isn't that
Hmm?
just a function of price? Because it's infinitely divisible.
Yeah, it's infinitely divisible, sure. So eventually, what are you going to have? 1 gram is going to buy you a car. 1 gram of silver is going to buy you a car.
Well,
you see my point. So it becomes an issue of like, how far do we go? And also, the problem is that fiat currencies basically function by falling forward. Okay, you're constantly inflating the currency. Okay, mm-hmm. And by inflating the currency, it creates certain forward momentum in the economy. Okay. Now, the issue, and this is a long-term question, I'm talking centuries, we have to figure out that in the last 100 years, if you started from the Franco-Prussian War, then the last 150 years, 140 years, we have been in a fiat currency scheme, right?
Yep.
And if you look at it from a long-term historical perspective, this is an unprecedented experiment. Because never before has a fiat currency been implemented. And it has been implemented, of course, the various currencies, but I'm talking about a generalized regime worldwide. Starting from 1920 or 1913, whenever the Federal Reserve was implemented, I forgot when, we had in the United States a de facto, a fiat currency that was partially pegged to gold, completely unpegged starting in 73. Now, of course, since 73 until today, that's 40 years. Okay, yeah. Since the United States exited the Bretton Woods Agreement and got out of the dollar, the gold peg. Now, if you're saying that we're going to go straight to hell because of this unpegging, well, it's certainly taking a long time to get to hell. It's taken 40 years. Okay, the issue becomes: can this system continue? Okay. Or is it inevitably doomed? And if it is doomed, is it doomed to some crisis? Okay, some crisis that will explode it. Okay, I started to think that a crisis like that could happen. I'm of two minds because, like I said, these Federal Reserve customers, they're mighty sharp and they're very good at propping up this fiat currency. Now the issue becomes: will the problems continue to exacerbate to such a point where they do blow up? Okay.
Yeah.
Me, in my own personal, you should always go by what somebody does rather than what they say.
Yeah.
In my own personal case, I'm gold. Okay. I basically have gold and silver, and what I do is that I physical gold for the most part. I have a portion of my own investment portfolio that is in paper because I trade it. But my own sense is that kind of like I'm trading it because, it's still functioning. The MF Global thing is it's not pervasive yet,
No.
where everybody is screwed out of their money. But my sense is that I'm continuing to keep the paper stuff, but whenever I earn profits, I cut those profits out and convert them into physical gold.
Right.
Or physical silver. So whatever thing I discuss, it's more like a intellectual, thinking about it. Because what I'm actually doing is I'm terrified that one day I'm going to wake up and everything just went straight to hell.
Yes.
And it seems that these guys who are managing the system, rather than doing the smart thing like the Icelanders did, are just they are not standing still because it's politically more expedient for them. And that drives me crazy. I wish they'd just stop it, take the hit, let the chips fall where they may, and we can start over. Okay, but they keep stretching it and kicking it down the road, kicking the can down the road, and that can only gets bigger and bigger. And so it's like this nightmare. You see what I mean?
I do. And
I suspect that you're in the same boat as I am.
Yeah, yes, absolutely. But what's interesting, I think, is that you're taking two roles, I think, with gold and silver. One is as a trader. You're trading a bull market, or what you perceive to be a bull market. And a trader essentially is someone who buys something to sell it at a profit. But at the same time, you're building and you're accumulating if you like, protection against what, as time goes by, seems to be becoming increasingly inevitable. Is that fair?
Yes.
Yeah.
Yes. It's a very fair assumption. And my objective, frankly, in my investment strategy is very simple. When the crash comes, okay, I am thinking about that uncle of mine with that little POS Fiat 147. And him getting offered an apartment for it. I realized that a lot of property is going to be available at very reduced prices, and that the smart thing would be in a moment. I mean, Baron the Rothschild said it best: when there's blood on the street, buy property. Right?
Yeah.
When things are going worse, that's the time to buy, and that's when I'm certainly going to be buying. I mean, just as for instance, next quarter I'm going to be selling Apple. Because I think that Apple is going to do a tremendous quarter with this new iPhone. I've read some very smart people saying that they expect Apple to sell in the final months of the year something like 57 million phones.
Yeah, they're even talking about it lifting the GDP of the United States.
Yes, because they're gonna have an income. If those numbers are accurate, you're talking about $36 billion of revenue, which is a tremendous amount of revenue, right? And so these guys are just going to do very, very well. But of course, that's going to be the time to sell. That's because it's
exactly.
Obvious. It's
I think. So, Gonzalo, I think you're sort of bringing the Chilean experience of the car and the apartment and so on. I think sort of back into the current situation. I think it was a very, very good point for us to actually end, because this has been fascinating, and I'm very, very grateful that you've taken the time out to speak to us. And but very quickly, where else can our listeners find you? And do you have a subscription service? If you could.
Yes, I do. The easiest way to find me is just Google me, Gonzalo Lira. I'm the only one. And there's this. I have a subscription service called Gonzalo Lira's Strategic Planning Group, which is at www.liraspg.com. That people can find me there. And basically, the idea of a strategic planning group is that we analyze potential contingent events. And we discuss possible ways to deal with these contingent events. The ones that we've been dealing with have been what happens when the euro breaks up, what will happen with hyperinflation, what happens if there's a Middle Eastern war, and what happens if there's a problem with retirement funds in the United States. And these different units that we produce basically address these specific problems that I anticipate are going to be the problems in the foreseeable future, say the next, 2 to 5 years, and try to figure out a solution as to how to navigate these problems, what would be the smart investments, what would be the bad investments, and how to navigate these very trying times. Because it seems to me that we have big problems, unfortunately.
I think that's right. Well, anyway, Gonzalo, thank you very much indeed, and hopefully we'll do this again in the not too distant future, certainly before the whole world falls apart.
Great. Alasdair, it was my pleasure. Take care. Talk to you soon.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.